We had a question come in. Should I invest in Australia only or include international? This is a great question, and I think I'll start by saying if you wanted to build a share portfolio and you just had Australian equities, that's okay. There, I said it. If you wanted to do that, you can do that, that's fine. I will say if you wanted to buy an investment property in a suburb where the data says, oh, it's not good, don't do that, whatever, and you did it anyway, that's fine. Because what I'm saying is you can actually do what you want to do. But the purpose of the podcasts that I do, these videos, this clip is brought to you by the Quick Start Guide to Investing, my investing book, is to just educate you on the options that are available and potential pathways to take, we'll say. And it's totally okay to do something, but once you learn that there is better ways, other ways, more optimized ways, there could be other markets, other asset classes, you find yourself with an active decision whether I do diversify my portfolio and potentially buy other shares, or if I'm a property investor, well, I bought 2 houses in this one postcode. Do I buy a third one in that one postcode? Well, hey, there's other postcodes out there that could give you the diversity that your portfolio needs. But if you want to keep in that postcode, or if you want to keep in Australian shares, you can. But you just need to be aware of the consequences. And what do I mean by consequences? Well, generally speaking, a balanced or a portfolio, we'll call it a balanced portfolio. I'm not talking balanced, well, kind of am, but go with me. I'm not talking balanced as in, 70% growth and 30% equity, defensive and non-equities. I think I'm saying balanced as in a variety of different asset classes that your money is invested in. So the question is, should I invest in Australia or include international? Well, I'd say to the questioner, we live on a very, very small island in terms of population. My friend Nick, who I wrote the Quick Start Guide to Investing with, I think he's joked in the book that Australia, or the ASX 200 ETF, it could be seen as a thematic fund of financials and mines, because Australia and the broad market is banks and miners. Don't at me, but so we've got a very limited market. Now, the Australian stock market is a very, very well-performing market. But the thing is, there are more people in Greater LA than there are in Australia. So just on that comment alone, we have this thing called I think they call it like a home bias, where, because we live here, because it's Australia and because we know it, well, it's obviously going to be a better investment than the rest of the world. So Australia only makes up about 2% of global equity markets. Okay. So the question that you need to ask yourself, and I will preface this with, if you're just starting out and you are working on your analysis paralysis, because the last 2 clips that I did were on analysis paralysis and being comfortable with risk, it's totally okay while you get your skates on and get up and running and get more comfortable with investing that you just do stick to Australia. Because the cool thing is, any Australian ETF of the ASX 200, it's very transparent and diversified. You'll know that of every $1,000 that I put into the ASX 200, $800 of that, or whatever it might be, is in, what did I say, $1,000? No, $80 might be in CBA or something like that. If CBA is 8%, did I get that right? Anyway, it's been a long life. You'll know that you could have a portfolio of $10,000 and $800 is in CBA, because it's literally reflecting the Australian market. And for a long time, the Aussie market has performed well. There's a lot of high dividend companies in Australia, namely the banks, and it's a good market, but we only make up 2% of the entire world. So what do you do? Well, I think general economic or portfolio construction says, as we've talked about in the last few episodes of this investing chat, is we want to have some type of exposure to other markets, because when things might not be going as well in Australia, other markets could be going well. And a really good example is coming off the back of COVID, for example, the US market actually performed quite better and recovered faster than the ASX 200, because there was a lot of we had a lot of tech growth. We had things just got up and happening faster. And as an investor that has a balanced portfolio, I want you to have exposure to Australian shares, international shares, because when some parts of your portfolio aren't performing as well, the other parts will do the heavy lifting. And it's as simple as that. So another thing that is really important to understand with, investing off the island, getting off the island with our money, most of the biggest companies in the world that you use daily, that you pay subscriptions for, they are listed on the US stock exchange. And even if you invested in the S&P 500, which is the top 500 companies in America, you do get some pseudo-global exposure because, for example, Microsoft and Apple are on the US stock exchange and they sell their products all around the world. So it's not as if I have to find a way to get in on the Indian stock exchange or the British stock exchange or the Chinese exchange or the Japanese exchange, because if there are these big international companies selling products in those markets, well, it's an easy gateway to have that diversity. So I'm such a big believer that, yes, we should, in a perfect world, be investing in not only Australian equities, but global equities. Another thing that as part of the diversification toolkit, it's not only, so when we look at shares, there is Australian shares, international shares. Now within that, we've got different sectors. So there could be financials, so the banks, there could be mining stuff like, your coal miners or your iron ore miners. There could be industrials like your laboratories and stuff like that. There could be consumer staples like your Woolworths and JB Hi-Fi and all that discretionary stuff. So within the asset class, you've got other little asset classes. Now, one thing that you don't get exposure to when you invest in just Australia only is the currency exposure. So by investing, for example, in the broader world, like the US equities or other equities around the world, you do get exposure to the currency. What do I mean by that? Well, if the US dollar increases, it'd be cool to have exposure on that pickup, right? If it decreases, well, that sucks, but there could be some other things in your portfolio that don't correlate to currency. It could be a little gold thing or whatever. So I think I really want to encourage you that, yes, if you are getting started, it's totally fine just to invest in Australia. There could be some other reasons why you might want to invest in Australia only. If you had a superannuation pension account with a 0% tax rate, if you had, and I used to do this as a financial advisor, we would put the pension account with a bit of a skew to dividend Aussie equities, because with the franking credits in there at a 0% tax rate, you actually get a higher return because in theory you get that cash back from the government, and they were trying to stop that, but there was big backlash. But so there are reasons where you might have a higher skew to Australia or particularly dividend stocks, because a lot of the other stocks around the world aren't known for or as many kind of dividend paying equities, I guess, in proportion to what's on the ASX. So the question is to you, what are you going to do going forward? I think my portfolio might only have like a 30% exposure to Australian equities, and then the rest is, other stuff. But yeah, I'm a big believer in the Australian share market, but I'm also a big believer in getting off the island with our investing. Understanding that we have to walk through the analysis paralysis, and investing in just an Australian-only ETF is better than not investing at all. Investing in a blended portfolio that has diversification and you understand it is likely better than just one Aussie equity ETF. So you just have to do what you are comfortable with, get schooled up, get educated, and maybe in the comments, if you are watching this on YouTube, let me know what your allocation to international equities are within your portfolio or the portfolio in a box solution that you use. So we'll leave it there. My name's Glen James. Thank you so much for watching today. You can check out the book, The Quick Start Guide to Investing. There's a link in the show notes. If this has been of value, let me know what you want me to talk about. And I'm trying to do this in under 10 minutes or less. And I'd appreciate it if you send any of our stuff to a friend or family member. I'll see you later. Remember, it's easy to get invested. It's harder to stay invested.
Any advice is general financial advice only, which does not take into account your objectives, financial situation, or needs. Because of that, you should consider if the advice is appropriate to you and your needs before acting on the information. If you do choose to buy a financial product, read the product disclosure statement, PDS, and target market determination, TMD, and obtain appropriate financial advice tailored to your needs. Simo Interactive Pty Ltd, the publisher of this podcast, and Glen James are authorised representatives of Money Sherpa Pty Ltd, which holds financial services license 451289. Opinions or comments from any guests on the podcast are theirs and not those of the host or the publisher or their respective license holders.